Hello everyone, thank you so much for joining. This session is about expense recognition. We provided an introduction to accrual accounting and revenue recognition earlier. Under expense recognition, there are in general three different methods how expenses are recognized. The first one is called matching principle. The other one is expensing as incurred. And the last one is capitalization with depreciation or amortization. The difference is depreciation is for tangible goods and amortization is for intangible goods. Tangible and intangible. Yeah, so what does it mean, expense recognition? How can we think about it? I believe the easiest way to understand is again to look at our income statement. Let's just make it a bit more detailed. Minus D&A, EBIT, and so on. Yeah, we leave this blank, don't need to go into detail. Revenue, cost of goods sold, gross profit, SG&A, EBITDA, minus depreciation, amortization. Then you have EBIT, then you deduct interest, tax, and so on, net income, dividends, retained earnings. Good. Matching principle. And again, we are not looking at this topic from an accounting perspective. It's a bit more complicated. Just want to give you an overview. If we look at matching principle, and here we use this mainly for cost of goods sold, is when you sell a product. Let's say in our earlier example, when we talked about revenue recognition, we talked about selling the product for $100. If the cost of the product, raw material, whatever goes in, is worth 30, that's your cost of goods sold. For sure, you incur those costs earlier because you pay raw material, you buy raw material from your supplier, you have some additional costs that happens earlier, you manufacture the product, and then in March you sell the product. You would recognize the underlying expense, not when incurred, not when you pay, not when you buy raw material from your supplier. You would recognize and record the underlying cost when you recognize your revenue. So in this example, in March. Yeah. So under matching, a company recognizes expenses, for example, cost of goods sold, when associated revenues are recognized. And therefore expenses and revenues are matched. Quite simple, because cost of goods sold, direct cost, go into the product, so the matching principle is used. When we think about costs that are a bit unrelated to the product, for example, payroll, IT systems, office leases, you need to pay for them not directly because you're selling products. You need to pay for them throughout the year, throughout the lifetime of a company. Here, especially when we talk about SG&A, those indirect costs, then we expense them as incurred. One example would be payroll, as said, IT systems. If you have costs in January, you recognize the cost in January. If you use the office in February, you recognize the cost in February and so on. Here again, it doesn't matter when you pay. We are not looking at cash accounting, we're looking at accrual accounting, but basically when it's used. Yeah, expensing as incurred, also called period costs, expenditures that less directly match revenue are expensed as incurred. And the last one is capitalization with subsequent depreciation. So if there are certain costs, for example, long-lived assets, property, plant, equipment, there are different rules under IFRS and US GAAP in terms of what needs to be expensed and capitalized. But when you capitalize a cost, then it would not flow through the income statement directly. You would not recognize it here. You would not recognize it here. You would recognize it on the balance sheet as an asset. And then what would happen is through the useful life of this asset, you would recognize depreciation. So if you pay something for 1,000 and again, or let's say 1 million, and it has a useful life of 10 years. So you buy a production machine or an asset for 1 million, 10 years. What you would do if it's straight line depreciation, you would add a kind of cost item in your income statement every year about 100,000. So over 10 years, if you record a depreciation and amortization item, 100,000, then at the end of 10 years, after you can no longer use, that's useful life, the balance sheet asset would basically be written down. Yeah, so 3 ways. These are for long-term assets, PP&E, etc. Yeah, again, accounting is a bit more complicated, but just to give you an overview, expense recognition either directly matched with revenue for more direct expenses and cost, expensing as incurred for more indirect cost like SG&A, and capitalization for long-lived assets. Okay. Perfect. I hope you find this useful. Thank you so much and talk to you later.